Welcome to the Active Allocator Insight Series. We hope that educational presentations, such as this one, will further your understanding of asset allocation and portfolio construction. In this video, we illustrate how Active Allocator can be used to understand credit and market risks and to appropriately allocate to them. So let's get started. Hedge funds take speculative positions in a combination of market and credit risk instruments, where the risk-reward relationship is attractive. And these positions can lead to arbitrage or risk arbitrage. It can be complicated to get one's arms around all the trades that hedge funds make, but the general idea is that Active Allocator lets you participate in them so that you can create a variety of non-directional, semi-directional, and directional exposures in your portfolio. Market risk specifically addresses asset price risk. The market prices of financial instruments can be highly volatile. For instance, price movements of derivative contracts are influenced by interest rates, market volatility, the price of the underlying asset changing, or even changes in liquidity conditions. Changes in the financial market environment are often the fundamental cause for price moves. By environment, we mean things like changing supply and demand relationships, fiscal, monetary, and exchange rate policy, or international economic events. All these factors are ultimately uncertain, and news can influence prices, giving rise to market price risk. Active Allocator lets you calculate the beta of your portfolio to a changing market. You can quickly compute your value at risk, too. Credit risk is very different from market risk. It comes from uncertainty about a counterparty's ability or willingness to meet its debt obligations. In assessing credit risk from a single counterparty, hedge funds almost always consider what they refer to as the default probability, their credit exposure, and the amount they expect to recover in the event of bankruptcy or default. Credit hedge fund managers arrive at their own views of credit exposure and recoveries, and take long or short positions in the underlying security. Active Allocator allows you to allocate to a variety of credit hedge fund types, including those in private debt. We do point out that credit risks and market risks, although often considered separately, are in fact intimately related. This is best seen when considering debt securities, such as corporate bonds. For a hold-to-maturity investor, the only risk that really matters is credit risk, whether the issuer defaults at some point in time prior to maturity. However, for any shorter-term oriented investor, or more generally anyone who may sell the corporate bond before maturity, credit risk translates into market risk as the price of the bond may fall in the interim. Hedge fund trading strategies often exploit the interrelation between credit and market risk. After formally examining fundamental value and market-observed pricing interrelationships between credit instruments and equity, or equity-based options on the same issuer, they arbitrage mispricing. Active Allocator supports allocation to relative value, global macro, and long-short hedge funds participating in such trades. Leverage is about borrowing money to increase the effective size of the portfolio, or purchasing securities on margin, or synthetically gaining exposure through futures or options contracts. When the return of the underlying asset is higher than the borrowing rate, leverage offers a much higher return. But leverage also amplifies the risk, both credit risk as well as market risk. The other concept is short selling. This involves the sale of a security not owned by the seller, a technique used to take advantage of an anticipated price decline. Active Allocator allows you to include leveraged and short structures in your portfolio. Hedging is essentially a defensive strategy to mitigate the risk of loss to capital. Think about it as purchasing insurance against the likelihood of an unfavorable event. Depending on the type of risk exposure created by the investment strategy, different types of risk can be hedged. For example, currency risk, interest rate risk, market risk, company risk. Active Allocator helps you create non-directional and market-neutral exposure that hedge your portfolio. In summary, trading strategies are a combination of informed or speculative trades on credit risk and market risk. Understanding the concepts behind credit risk and market risk is the foundation to understand hedge fund trading strategies. All of this can be complicated. The good news is we process all of this in our optimization and allocation algorithms for you. We encourage you to take a test drive, build a few model portfolios, and see how Active Allocator might be useful for your clients. Thank you for listening in.